The Case-Shiller 20-city home price index rose more than forecast in June, up more than 4% over a year ago. And what about real estate investment more broadly? Well, the Bloomberg Real Estate Investment Trust Index up today as well. You can see about 1% right now. Joining me now is Jay Leupp. He's the founder and senior portfolio manager at Grubb and Ellis AGA Mutual Funds. Jay helps oversee $5 billion in real estate-related assets. Jay, thanks for joining us. Nice to talk to you again.
Great to be here again.
So, first of all, tell me your read on the Case-Shiller. As we talked about, we did see a bit of an increase, but is that mostly due to the lingering effects of some of the tax incentives and first-time home buyer incentives that were out there?
We think so. Part of that price increase reflects a surge in demand, basically home buyers taking advantage of tax incentives that were on the calendar to expire. So it was natural to expect both a surge in sales as well as a surge in prices. Going forward, we're not predicting that home prices will appreciate at a 4% annual rate, but we do think that home prices in general are in the process of bottoming.
Well, and is that a good thing? I mean, do you want the prices to go down? Because that might be one of the things that finally gets people to buy in a little more volume.
Sure. Definitely any movement downward in price that makes for sale housing more affordable should help spur demand. But at some point, the price reductions are sort of like pushing on a string, much the same as the Fed continuing to lower interest rates has less and less of an effect on increasing economic activity. Bottom line, Julie, is that we need more job growth to spur demand for new housing. We need people to feel secure about their jobs, secure about their careers, secure about their economic future. That will cause them to step forward and make that home purchase. So
when you're looking across the real estate spectrum here, Jay, where are you seeing opportunities right now? I'm guessing you're not necessarily looking, for instance, at home builders right now. You're looking at some of the larger real estate investment trusts?
Right now, we're looking at real estate investment trusts. We see a lot of fragmentation in the market right now, and that really reflects what's going on in commercial real estate. It's really a tale of different markets. Right now in the commercial real estate space, office buildings, apartments, shopping centers, premium assets in premium cities are trading at premium prices. And then we have the rest of the commercial real estate world where there are ample opportunities to invest in real estate and achieve higher than average yields.
And when you talk about some of the premium properties here, I know you guys like Boston Properties, which is an office REIT. I have to also ask you, when we talk about some of these commercial real estate issues, you know, there was a lot of talk about commercial real estate crashing, but it doesn't seem like that ever really happened, did it?
No, it didn't. I mean, we never really saw the next shoe to drop, so to speak, that we saw in residential housing. And part of that is the way that commercial real estate is financed. You have real estate investment trusts, which have raised over $30 billion in equity to shore up their balance sheets in the last 18 months. Those companies are healthy, so they're not losing properties to foreclosure in general, and they're actually net buyers of real estate right now. The net losers in commercial real estate were and are the highly levered local developer that can't get a property refinanced. And there's a lot less of that in terms of total assets than on a percentage basis than there is, for example, subprime borrowers losing their houses in housing. And so a few little shoes dropping in different markets, but nothing to the effect or at the level of the residential housing market that would lead to a crash in commercial real estate. Essentially, the industry is slowly working itself out.
Jay, let's get back to Boston Properties for just a minute. The last time they were out with earnings, the earnings looked relatively strong. But at the same time, one analyst we spoke to complained that the company has a lot of cash on hand, and they're not doing anything with it right now. They're not redeploying it. It's not earning anything. Is that a concern for you?
Well, we'd rather have them with a lot of cash on the balance sheet waiting to pursue opportunities than have them being highly levered and out of cash. So if we're choosing between those two alternatives, having excess cash in this environment, we believe is a good thing. But having excess cash on the balance sheet is also dilutive in that it's not earning the same rate as its normal real estate investments. A company like Boston Properties is well positioned to take advantage of opportunities as they arise.